While we briefly covered Japanese candlestick charting analysis in the previous Forex lesson, we'll now dig in a little and discuss them more in detail. Let's do a quick review first. Japanese candlestick trading. Back in the day, when Godzilla was still a cute little lizard, the Japanese created their own old-school version of technical analysis to trade rice. That's right, rice. Traders be hustin back then also. To rock ice, you traded rice. A Westerner by the name of Steve Nison discovered this secret technique called Japanese candlesticks, learning it from a fellow Japanese broker. Steve researched, studied, lived, breathed, ate candlesticks, and began to write about it. Slowly, this secret technique grew in popularity in the 90s. To make a long story short, without Steve Nison, candlestick charts might have remained a buried secret. Steve Nison is Mr. Candlestick. What are Japanese candlesticks? Japanese candlesticks can be used for any time frame, whether it be 1 day, 1 hour, 30 minutes. Whatever you want. They are used to describe the price action during the given time frame. Japanese candlesticks are formed using the open, high, low, and close of the chosen time period. If the close is above the open, then a hollow candlestick, usually displayed as white, is drawn. If the close is below the open, then a filled candlestick, usually displayed as black, is drawn. The hollow, or filled section of the candlestick, is called the real body or body. Thin lines poking above and below the body display the high-low range and are called shadows. The top of the upper shadow is the HIGH. The bottom of the lower shadow is the LOW. Stay tuned by subscribing to the channel. Thanks for watching the video.